TGIF, Face Warriors. Good morning, Louise. Everyone doing okay? Hope everyone had a good week. I had some challenges this week. I want to share something that I learned from John Bollinger, who, of course, you see these bands here, Bollinger bands, right? Everyone see this? So this is something I learned from him, that when you get compression like this and the bands start compressing, that what you do is you wait for the first move out of this, and that first breakout of a Bollinger Band, not always, like everything, nothing is always in this business. Hello, Khalid. That the first move outside of this squeezing of the bands break out as a fake out. So you have to admit, S&P is really one heck of a recovery from where we were Monday. What I'm thinking here is that we get a breakout to the upside maybe early next week over this blue band. Try 40. I mean, 60 was really an important area. Not sure if it'll get up there, but you let it break out, and then the next time back inside the bands is the move that's going to happen. So this is something I'll be looking to do early next week. So now we could look at the weekly. I'm going to bring in some Steve Volge, who's our candlestick expert, what kind of candle this is. I mean, I know a name of a few, and we're not close, but perhaps, Steve, if you're listening, is this a hanging man or a hangman? Or if you shorted the lows this week, would you hang yourself? Anyway, we'll see what Steve thinks about this candle, but what a recovery. And, I'll admit it, I didn't think that we'd recapture almost all the gains. We're not that much lower on the week, right? And it's not like there's been any resolution. The only thing that's taken pressure off it has been that we haven't had a new high in the yuan since Monday. But we'll get one. It looks like we'll get one. I don't think this is it. Pretty strong momentum reading up there on the 4-hour. 1 hour had a little divergence. So maybe we pull back still, this could be an A and this whole elongated thing's B, and maybe we get a pullback just to above the 7 breakout. And that would take some pressure off the market for another few days. You can't see BBs. They're right here. Anyway, gold, great week. And I would have been more bearish, and I know it's crazy to be bearish gold and silver up here. But if you're a member, a subscriber, take a look at what Greg is saying long-term on the weeklies. A gallows pole? I'll ask Steve Bolva about that Forex gal. So, I think it's reasonable to think that we could get a pullback somewhere back towards this throw over breakout of what I thought was going to be a third drive, and throwovers can make you throw up. So I actually waited for this 1484, which is 50% back. And as you can tell, even though I sold some more at 1500, I'm underwater pretty good on this. Scalped a little bit when it came back to 1490, but great looking week. And a lot of it was dependent on the yen. I've been playing the yen from the long side. It's discouraging every time it gets going. It gets turned back, especially, when the S&Ps were up 40, that the yen couldn't do much. But I don't know about you. I have a hard time wanting to get short the yen down here. Almost looks like you have a 2 drive here, maybe a 3 drive. I think there's a low coming. reassess. Scalps were successful from Monday night and then did it again here. We really need to get over. First step is 106.30. This little level right here, 630, could take us back to 680. And I talked about 680 was the previous low before the new lows that we just got right here, 680. So when I look at this, to me, I think unless there's really something going on that I'm not aware of, like a crash, I think it's basing. Okay, and you never know. There's that old expression: you have to be there for the good all the time to be there for the good times. But very ominous looking weekly candle. So we'll see. I don't know if we're going to have any kind of resolution today. If we start trading back over 620, it's going to look a lot better. 620, then it'll get to 680, 107. So I just can't get bearish. The reason is, although there was some pretty good give back, my whole thesis is that's about to be, could be blown to smithereens, is a US dollar yen low and precious metals high. Here's the gold trying to roll over. You can't get long-term bearish unless we start closing back under 1470. Right now, I'm just assuming this is going to be, some type of pullback, but you never know. 1470, and so higher yen, lower gold, and a turn in yields, which, I talked about this with Steve yesterday, and we had a couple of good days. It's very possible that we had an inflection point there in yields. Bonds tagged their historic low, whereas 10-year, the previous low was 134, so it's a higher low. On a weekly basis, still, no reversal. But it's my contention, if we could start getting back above 180, which was the first bounce, 160, 180, that could take us to 2. And then if we ever get over 2, I think 240 to 260 is possible, with just as a correction from 325. So that's 1.8 in yield. We've cut yields in half from the end of last year. Why can't we get half of them back, is what I'm thinking here. Any questions on anything? So I'm still going with the thesis that we're going to get some type of US dollar yen low, which means yields could start heading up again, and that could pressure precious metals. And paying attention to the bully band squeeze on the S&Ps to do something there as well next week. So, I don't like to initiate a lot of new stuff on Friday. Friday's kind of an evening up or follow through day into early next week. So that's my take on the markets. I have one of my favorite guests and very good friend with us today, Jim Welsh. You don't want to miss it. I've seen Jim's presentation. He sent me his PowerPoint. And what I really like about Jim is his work is really based on the Fed a long time ago. And you could find guys that are great with fundamentals, but they don't really help you that much tactically, because it's a fundamental opinion, doesn't talk about, something that's happening technically that you could take advantage of. But Jim's unusual. He has both. He's an excellent technician, tactician, and its fundamental arguments are usually ahead of the curve. And I think he, for those of you that think that we might be entering some type of correction or bear market that might be beginning here, you want to stick around for Jim's interview. I know the whole team has read his stuff. Gosh, let's see, I've known Jim for over 25 years, and I can't tell you how many times his writings have really been a help to me with just understanding what's happening economically and ideas in the market to take advantage of that fundamental take before reporters start talking about it. So that's the difference between people that are on CNBC that report what's happening and why, and forecasters that see see what's coming down the road around the bend. So stick around for Jim Welsh. I know Blake enjoys him, and I know the team had a very decent week, and really recommend you guys become part of our community. Recommend you also talk to our sponsor if you're not 100% satisfied with where you're trading, or maybe you'd like to have another account. You go to Forest Park right on our website. I know many people have more than one account, no law against it. Some use it for separating the kind of trading they do, from day trading to swing position trading. And you're going to have the benefit, if you're overseas, to pay for the subscription reimbursed, or if you're in the US, a check for your car payment every month. So something for you. Huh?
Coach, good morning. Let me
Hi,
add
buddy.
to this that there is even the possibility to add Forest Park FX as an introductory broker to your existing account. So even if there is no better alternative for you and your trading style, I mean, in a different broker, you can still, if you haven't used an introductory broker, you can still use Forest Park FX as your introductory broker and get those benefits without having to switch or make a new account.
Oh, yeah. Yeah, good point, Steve. So while I have you, did you see that weekly candle in the S&P?
Yes, it is a pin bar. So far, it is too early to characterize it. Usually, we characterize by definition. If you isolate the candle, it is a hanging man.
Okay.
But you would characterize something like a hanging man found at the top of a trend. So in this case, if we close like this, a more accurate definition would be a hammer, albeit red in color, but it can still be a hammer. You know what I mean?
Okay. I mean, if I didn't have a bias, to me, it would look like this kind of recovery, that new highs would be a lock.
I agree with you. Although from a technical perspective, I haven't changed my mind.
Okay.
I'm still looking for a lower low, but I don't want to.
I haven't either.
I don't want to take Blake's time. I'll speak about it.
Okay. So maybe we could get some early week follow through, take out this week's high, and then reverse again sometime next week. Because I too, like you, think that they want to. I really think they want to take out this low here, Steve, at 27.
As I thought that 29.60 was critical to open up the downside.
Yeah, here we are again. Maybe. Yeah.
I think that 29.60 is going to be very critical for bulls to. Reclaim, exactly, to reclaim having the initiative of the move. So as long as we trade below 29.60, I still believe that one lower low is the scenario. Yes.
Okay, here's a bearish scenario. It's a megaphone line down here. So that means that we have some problems.
Theoretically speaking, that can happen as well. Yes.
Yeah. So stick around for Jim. He has some technicals that could back up that this could possibly happen. So thank you, Steve and Blake. I love working with all of you guys. By the end of the week, I know we're all exhausted, but it reminds me of being younger when I was into sports and playing hoops and everything else, that we come in every week and we lay it all out on the floor and give 110% all week for our community and people that haven't yet become part of our community. And TGIF happens since I've been with the company as a very satisfying day because I know what kind of work we've done during the week in our attempt and our mission to build up and edify traders every day. So very, the best gig I've ever had. How about that? And I've had a few thousand.
What?
Yeah, Blake, it is, man. I mean, I love working with you guys.
By the way, guys, we have housing start data in 5 seconds.
Oh gosh, yeah, I'm building a doghouse in the backyard.
Yeah. So let me tell you what we get. 2003.5 is expected.
Singing at the Coyote is a pretty good gig too, though. Like,
seems to be a little bit delayed.
they didn't get my doghouse in there.
Canadian house data, by the way.
Oh,
Yeah,
God.
everybody's waiting for the Canadian jobs report, so it really doesn't. It's irrelevant right now, right?
Indeed.
So okay, so forget it. I'm not even looking at that. So Coach had asked what kind of candle this is on the S&P on the weekly chart. It's actually a long lower shadow doji, which is
Okay.
ironically pretty bullish, but it can be if we close up here, because there are people that are caught short. If this candle was up at the top, at the very top of the range, then it would be a hanging man.
Okay.
So when it comes off an uptrend, that's usually what it is. But when it's dipped like that, it's almost like a hammer or a long lower shadow doji, which could be viewed as bullish.
Okay. Thank you.
Yeah.
Bro.
Oh, you're welcome. I mean, I thought the equity markets were going to rally, this week. And I actually thought we were going to stop here at 29.30 because this is the 618 retracement. We actually surpassed it. Yesterday, the Huawei news came out. Did I pronounce that correctly?
Yeah, Hawaii. Yeah, better than I could.
Yeah, but yeah, whatever. I use an Apple product, so what do I know? Or Apple products for phones anyway. But the thing is that we came off the highs after the close, and we came off a little bit. Now, I think the question is going to be where we're going to close today. I'm assuming August we are going to. The remainder of this month, we're going to be consolidating between, somewhere around this previous support zone, which will be the resistance zone now, this 2960, and probably like 2850 or something. The one thing that if I was just trading FX predominantly, what I'd be looking at right now is what I tweeted a little bit earlier is the U.S. dollar Japanese yen. This thing's trading really heavy, and any type of downdraft in equities might have a negative effect on the U.S. dollar Japanese yen, because if even if the stock market, from here, the S&P, like let's say we drop back below 2,900, question is what's it going to do to the dollar yen? And if you look at the dollar yen on a weekly basis, let's keep in mind that we're breaking down, right?
Yeah, it looks like it. Yeah.
Yeah, I mean it's trading heavy, and we're going to crack this weekly trend line if we close below here. And like you pointed out earlier, Dale, is if we close above 106.20, it's going to look a little better.
Yeah.
It's going to be like, okay, maybe that was just a false breakdown. But if we close down here, it's going to be ugly. And I said
I want that flash crash low, Blake. I mean, Aussie took it out. Why can't the yen take it out?
Yeah, well, actually, the Aussie did not yet.
Oh,
but the Kiwi has.
Right.
The Canadian came really close. No, we're off on the Canadian. The Euro yen did. The pound yen is just getting demolished here. And it,
well, there was a day this week when the other day, it was yesterday, I think, or the day before, S&Ps were up 48 and the yen couldn't get going.
What's that?
There was a day when the S&Ps were up 40, 45 handles and the yen could barely go.
Yeah, I mean that's the thing is the market the market is it's trading really just heavy. Just the dollar yen just in general. So the fact of the matter is the dollar yen is just if we crack this 105 today, I think that looks really easy for like the market to take a stab at that, but there's got to be a lot of stops below there. I'm assuming there's going to be a lot of stops below there. There's a risk that we try to stab below there, especially if equities come off. So anyway, this is this is just, I think, a risk in the market right now that we've got to just pay very close attention to, because if the dollar yen starts to come off, what happens? Do the equity markets respond to that? And I would think they would, because when you're dealing in the markets, it's like a domino effect. If one starts to move, then the other one starts to move as well. So that's that's just something that I just pay attention to, in FX. Now the euro dollar is just, it's kind of consolidated, but let's take a look at the dollar Canadian before these Canadian jobs reports. The Canadian is coming off. We're at channel support. So here we are, we're like right at channel support right now, or, you can say that we're close to, right? And this we've come in and out. So this channel is not perfect by any stretch of the means, so you got to give it a little bit of wiggle room around here. We might try to plunge a little bit lower, but I think that this is going to be pretty key support today. So 131.80, right? 131.80 is really going to be critical support. Okay, and I think for the market. And that's if we have a strong Canadian jobs report. So if we have a weak jobs report, you got to realize that this channel has been, it has been holding. So a move back above like 132.40 probably be a pretty bullish event. So this is when I'm looking at, and I don't think I'm going to trade the Canadian. I really, really doubt I'm going to, right? It's going to be something that looks like this, whether you go above or below, this upper end of the range or the lower end of the range. Okay. This is where, in my opinion, you're going to have like your breakouts. So if you get above 132.40, it's going to break out to the upside. You get below 131.80, we're going to break to the downside. And then you got to think about a little bit about risk appetite too. If stocks continue to be strong or continue to climb, then you may risk a move below 131.80, and probably pretty good too. So that's kind of what I'm looking for heading into the Canadian numbers. And like I said, I'm not going to trade them today. I've had a really great week, and matter of fact, this week I've done more production than I do most of the times in a month, and that's all in the recent year, and that's just because volatility has picked up. So with volatility picked up, it's productivity is obviously a little bit better. For me, it's been good. I've basically made up my what it's been my normal monthly production in like just a week. So I don't want to like piss it away trading on a not great risk reward setup here, especially with Canadian jobs numbers. But for those of you that are looking to trade it, that's the way I'd be looking at it right now. Move above 132.40, move below 131.80. It's kind of a, it just depends what the Canadian numbers come out at, and your guess is probably better than mine, because I tend to be really bad at guessing jobs reports anyway. Let's see. What else I want to trade? What else do I want to look at? Let's take a look at the dollar CNH. So this is the US dollar CNH. This is something else that this is something else that I think we all need to pay attention to. Is we had this big breakout on the US dollar CNH. One of the reasons why the US dollar Japanese yen, in my opinion, is still trading really heavy is because the US dollar CNH is still broken out. And this is something that we talked about obviously before the week ahead video, or on the week ahead video on Sunday, that this breakout would occur. It broke out and now it's holding. And a lot of people think that that from here, the natural path of the US dollar CNH is a continuation higher, as long as trade tensions remain strained, which I would say is realistic right now, unless something gets done. This US dollar CNH is going to continue to rally. And if it continues to rally, then that should keep the downside pressure on the US dollar Japanese yen as well. So just some things that just some things that I'm paying attention to going into the going into the weekend is that you know, let's watch the US dollar Japanese yen, how it trades above the 105.50, and then obviously as we go into the Canadian jobs report, you know, you guys got your levels there. So with that being said, I want to stop really quick and mention that if you haven't signed up for the Trader Fest 2019, I tweeted out a link, and for those of you that are you know, looking to be part of the ForexAnalytix community, all right, come watch the presentation, use the link that we have, because you'll be able to get a discount for a month. So if you're wanting to try out ForexAnalytix, that's the way to do it, in my opinion, especially in, you know, as we're in August. And then if you haven't visited our webinar sponsor, that's Forest Park FX. They are you know, the best at trying to find you a broker that's best suited to fit your needs. So make sure that you click on, you know, the Forest Park link or the reimbursement program on ForexAnalytix website. So this way you can chat with them, you can Skype them or send them an email, and then they can assist you from there. So Steve.
Hey, Blake, I was just putting the link in the chat as well.
Oh, great. Okay, so hey, you know, and let's take, you know, I'm not trading the Canadian numbers. At least I don't think so. Well, I guess we'll see. But let's I'll stick with you for the next few minutes as we release this data. Let's see what happens with the dollar Canadian. Here is let me get rid of that and get rid of that, and we can, you know what we can do. We can set an alarm here. We can set an alarm here. Let's see what these numbers come in as. So what are we looking for data, Steve? And then I'll flip it over to you after the data comes out.
We have a lot of upcoming data. US PPI looking at 0.2, US PPI month on month the same, US PPI year on year looking for 1.7, US core PPI looking for 2.4, Canadian building permits looking for 1.5, Canadian employment change looking for 12.5 positive, Canadian unemployment rate looking for 5.5%, and Canadian participation rate looking for 65.7. Those are all the data we're waiting for.
All right, let's see what gets released with this. You know, obviously, I'm going to keep the Canadian on here because we're going to be watching for the employment data. You know, they're looking to create 12,000 jobs. Unemployment rates looking to stay the same. Participation rate looking to stay the same. So look for any
Crown Royal. I love Crown Royal in that purple bag.
I am a big Crown. By the way, Crown is like my favorite.
Oh, we have something, finally something in common.
Finally, I know. It's amazing considering that you're 432 years older than me. So
my Crown Royal is aged.
Yeah, you've been buying it since like the dark ages. No, I'm really a Crown fan. That's like it's my Achilles heel.
Drink it straight or with a splash of soda.
Depends how I feel. You know, sometimes I like it on the rocks. I'm not a dry, you know, Canadian Crown Royal.
Yeah, try with a splash of club soda and a lemon twist.
Yeah, you know that's good. You know, I don't mind with a little splash of 7-Up sometimes.
Oh,
you know. So
that's like your college days.
Yeah, exactly. It depends if I'm in the mood for something a little sweeter, but yeah. Anyway, all right, guys, we are real close to this data coming out. We are, let's see, how many seconds away? About 30 seconds away.
I have 1,000 purple sacks.
Do you? I used to keep them for my golf balls.
Clubs? Oh, balls.
But not clubs, my balls. Golf balls.
Okay. I won't say anything more.
Someone is overly enthusiastic, I hear here.
Yeah, and he's like a giddy little kid when you mentioned balls.
He is, isn't he?
It's like if you say penis to my 12-year-old, he gets all he said penis. All right, here we go. Whoa, weak data. Wow.
Oh, a Red Sea all over the place.
Yeah. Yeah. Producer prices came in a little bit weaker. So
Canadian data are all bad.
yeah, so you look for dips back down to 132.40. You're probably going to find some buyers here.
Just look at that nominal jump, Blake, in unemployment from fifth.
Are we losing
You're
Steve right
breaking
now?
up. Yeah, he breaks up. A
Okay.
little bit. Yeah.
We're losing Steve. He got so excited we lost him. Hey, Steve, you there? Yeah, we can hear you now. He just got super excited or something.
Okay. So I was saying that it is very peculiar that we got a jump in unemployment rate by 0.2 from 5.5 to 5.7, despite participation rate dropping. So theoretically speaking, participation rate should be helping Canadian unemployment stay low. And despite that, we have a jump from 5.5 to 5.7%. So the unemployment change was really big. I mean, we expected a positive 12.5 thousand jobs created, and we lost 24.2 thousand jobs. So in essence, data was employment was 36.7 thousand weaker than expected.
Now that's crazy, and it's a pretty big jump. And look at the Canadian yen has just gotten absolutely smashed. I tried to play this on the long side, playing it back above 80 or close to 80. I was thinking it was going to be a false breakdown, but got out of it yesterday, fortunately, because we've really cracked lower here. This is not good Canadian employment data, but I wouldn't chase it higher. I would just be buying dips now on the dollar CAD. All right, Steve. Well, hey, I'm going to pass it over to you. You guys, I'm going to be getting up extremely early tomorrow morning on a Saturday morning to do this Trader Fest. So I hope you guys join me, and it should be good. My part's only 45 minutes or so, but I think the content, you guys are going to really enjoy it. So I'll see you then, and you guys all have a great one, and TGIF to everybody.
Have a good weekend, buddy.
All right, thanks. You too.
Have a nice rest of the Friday. Bye-bye.
Hey, Coach.
Yeah.
Balls. All right, see you later.
Football.
It reminds me Duke Nukem,
football.
Balls of Steel. How have you been, Coach?
Oh, just juggling balls.
Oh my God. I feel like we opened the Pandora's box.
Anyway, a lot of choppy things I've tried this week, Steve. So my whole thesis, the linchpin was the yen, which is threatening my thesis. We got that one-day bounce in yields, and gold. I've taken heat on, so I'm glad this week is over. Not a lot of clarity. I don't know what to do with the Dixie itself, because of the bifurcation of euro pound and everything. So not a lot of clarity.
You don't know what to do with the Dixie simply because, let's be honest, there is no real strong trend here. So it's not easy. It's not easy to know what to do with the Dixie.
Yeah.
I mean, just look at this.
I think Jim thinks it's topped and we're going to 94.
Listen, that can be the case, but I need to see more evidence. And, when I'm talking about more evidence, as I was explaining yesterday, ideally to confirm that we are in some kind of a, bigger corrective move lower, or even, a big reversal lower, I would want to see a lower low. That means that 95.84 is going to be taken out, has to be taken out to the downside. That's the only way that I can feel comfortable about selling the Dixie across the board, or anyhow almost across the board, right?
Yeah.
Until that happens, I think that jumping the gun is quite dangerous, right? Now, of course, you can do any type of trading as long as you have a plan in place that gives you some viable risk-reward ratio to what you're doing. So if you have a plan in place that you know where you're willing to take your loss, you know where you're looking to take your profit, and that gives you a risk-reward that makes mathematical sense, sure. I mean, somebody can go ahead and, trade whatever they want.
You sure made a nice call on the gold-silver ratio. I mean, today's a perfect example. Gold down 8 and silver's still up a nickel. You're breaking up a little.
Yeah, I think it's these. I'm on my MacBook, and it's this headset that I'm using, which is a Bluetooth. I think every time the squawk is speaking in my ears for some reason, my voice is getting lost a little bit. So gold-silver ratio, I still think that there is a possibility for another
ABC. Okay.
Yeah, for another high towards 61.8 or towards 91 before lower. So there is there is a possibility that we're going to get one more high from here, so even a better selling opportunity. Of course, that's not a given. So I think scaling in makes sense. Using the exact same logic, I sold yesterday again S&P at 2930 because listen, 2930 is the 61.8, 2940 is the equality target, which is exactly where we stopped. It's the equality target of the 2 legs higher, and then, as I said before, 2960 is super major level, because if bulls manage to take 2960 out and we start trading above it once again, then there is an overwhelming chance that we're headed to new highs. But personally, I do believe I sold yesterday 50% of a position, half of a position, because as I said, there is the potential for seeing higher prices.
Look at that what's that RSI low reading down there at the low of the week on Monday?
Oh, it was in the teens, 14, something like, 14, roughly 14.
Yeah. That'd be pretty unusual for a market for that to be a bottom.
Indeed, a very, very low reading.
Yeah, okay, thank you.
A very, very low reading indeed. So I have really nothing to add having to do with the S&P. I mean, I still believe that against 2960, there is a very viable risk-reward ratio for a move to the downside. One thing I wanted to mention, though, and if you remember, I think I mentioned it yesterday as well, definitely the day before yesterday, but I think yesterday again as well, is this. If you remember, I said that the cable looks like it's going to break down. And there it is. The reason I believed it's going to break down is we had this triangle. I mean, this is a textbook triangle, right? And as I was saying, we had, now if you have a look at it on the daily chart, here it is, we had these triple confluence of supports at 121, but after spending like 7 days consolidating and completely unable to actually rebound higher,
weak.
Yeah, very, very weak reaction. And look at this. We're already trading below 121. And in all honesty, if you go back to the daily chart, I don't really see any support until 119, the spike low. Although keep that in mind, this was the post-Brexit spike low. And I know that depends on which brokerage firm's chart you're looking for. I mean, here is FXCM has it at 119. If I remember right, there are some other charts you can find that have a low at 117.50, 118, or whatever, because that was simply a spike. So I don't actually know what was the exact low across the market. But I can tell you one thing for sure, 117.50 is also a level of interest. Why? Because it's the 61.8% extension of the last rebound. bottom line, be very careful, because if the daily and weekly close today confirm that, we've breached 121 on a closing basis, I think that cable is going to remain under pressure, and there is really no surprise that, let's go to the euro pound, because I know that a lot of people were trying to top pick the euro pound. I was among them, but only as long as the euro pound was still holding this descending channel, because once it broke above it, fighting it was a very, very bad idea, as I had mentioned. And you can see that once we confirmed the breakout from this descending channel, which was a corrective pattern clearly, euro pound actually went vertical. Okay, so prices dropped for the first time. So I think it would be a dangerous proposition for anybody to be looking to fade this. At some point, it should pull back, but might happen from here, might even happen from up there. No matter where it happens from, I can tell you one thing for sure: 91 cents is going to be a very tough level to break to the downside. Okay, so I think that at some point we're going to get a pullback, and it's probably going to give us some type of price action like that. That's what I would expect from the euro pound from this point on. Okay, an eventual pullback, if you're lucky to retest 91 cents, and I'm saying if you're lucky because I think that's going to be an amazing risk reward opportunity to be buying euro pound. And eventually, in the longer term, I would be looking for a continuation higher, and later on, might be this year, later on this year, might be next year, I think that the market is going to produce an excellent opportunity to be short the euro pound as a longer term trade, but not yet. Absolutely not yet. So it's a different story that I have a longer term plan, that at some point I'm more than certain that I want to be selling the euro against the pound, but we're not even close to doing that. And until I feel that that time has come, in which case, it's going to be a combination of technicals and fundamentals, I think that euro pound will be a pair that you should be looking to buy. Now, let's have a look at a few other of the crosses. When we were trading at the 127% extension here in the Euro Aussie, I said that, listen, the Euro Aussie might produce a buying opportunity if it pulls back towards this area. It has now done so. So, the risk reward would favor longs from here. Before it actually did that, it actually spiked to the peak, to the 161.8% extension. I think that, this is really worth monitoring, because we're going to find out if this break above this wedge was, the real deal, or if it actually was some kind of a false break spike higher. And how are we going to know that? We're going to know that if we see an acceleration lower and we break back below this ascending wedge. But, it's too early to tell. Until that happens, I'm monitoring. To be honest, I would eventually want to be short the Euro Aussie, but only if it broke below this wedge support, and we're nowhere there yet. And here's the Euro Kiwi. Euro Kiwi a lot more mixed than Euro Aussie. As you see, it hasn't been breaking to new highs. It definitely had like a vertical move higher. We found resistance at this horizontal support resistance area after spiking to the 78.6. So could you fade this? Yes, but just by looking at this chart, personally, I don't want to do anything with it. Equivalently, if we have a look at the pound Aussie and pound Kiwi, obviously pound being as weak as it is, it favors short positions in comparison to the equivalent euro pair. So, for example, if you're looking to be short those pairs, until proven otherwise, and as long as the euro pound is in an uptrend, you have to respect the downside here, and here it is. I was monitoring this descending channel. We had that spike higher, but we're now back below it. So pound Aussie, quite weak. Pound Kiwi, you can see here, more or less the same. Perhaps we finished some kind of an irregular correction here. Keep in mind that we've never managed to close above the on a daily basis above this horizontal support resistance area. 183.70 is going to be a major support area. I think that if we break below that, then we should be looking for a lot more downside. Look at the RSI as well, because I'm paying attention to that. The jump higher to the RSI found resistance at 60, so that clearly shows that we might still be in a downtrend. And if we do break below this ascending trend line, I will also consider that as a signal that the pair is continuing lower. One thing that is also worth mentioning is that we had been monitoring this huge and long-term ascending channel, likely corrective. You can see it dates back to the summer of 2016. We briefly broke below it, but we've never managed to accelerate lower. Let's see if we can actually break below it once again, and this time, produce some continuation. We have to take the previous low out first, obviously, but it looks like the pound Kiwi might actually end up doing this move. That's going to be a major technical event with very long-term implications. So I still favor the downside in this pairs, but I want to see some confirmation, because the fact that we broke lower short term, we broke back above it again. I don't like this type of price action. I usually like to see breakouts with definitive momentum, and an acceleration lower to confirm. But that doesn't mean that it's not going to work out, right? We just need to give it more time and decide what's going to happen here. As you see, I'm trying to focus today on things that we haven't been covering on a daily basis since Monday. But let me have a look at your questions. USD CAD. Okay, we have a question about USD CAD, and since we did have USD CAD data, we had Canadian data and USD data. So let's have a look at it, because the USD CAD, if you remember, I mentioned multiple times, I mentioned it in the chat room as well, that 133 was a major resistance area. It's a triple confluence of resistances, and at some point, 2 days back, while we were on the webinar, the pair was trading above it. And they said, that's going to be a major level to break above. But look at this. The market actually, never managed to sustain anything than an intraday break above it. So bottom line, 133 held like a champ. Yesterday, we had quite a big reversal lower. Actually, if you focus on the last 3 candles, excluding today's, because of course the day hasn't closed, we had an evening star formation here on the daily chart. So quite a nice bearish reversal signal. So far, we're seeing the market pare back some of yesterday's losses. But, despite the very, very weak Canadian data that we got, as you see, we haven't managed to retrace more than, half of that. And I do think that, if you really want to trade this in the short term, short positions against 133 are not a bad idea, right? Now, on the other hand, 130, we had indicated that multiple times, was, a huge confluence of supports. Mostly, the most important support here was this multi-year ascending channel, a 2-year ascending channel. We held that. So, if we want to look at the long-term picture, we had another higher low here. So you need to respect the upside. But as I said, if you're looking for shorter term positions against 133, it might be worth looking for short positions for some type of deeper pullback, I would expect that 130, 150 should be a significant area of support. And of course, if we make it below there, then we're talking about a retest, another retest of this ascending channel support. Now, let's see the reaction from CAD yen, since we had weak Canadian data. It remains bearish. Obviously, as you see, we got rejected from this horizontal support resistance area. So 2 days ago we tested the 78.6 from this spike low. There is no real evidence here that the pair is turning higher. I see, if you want to zoom out, since we broke below this ascending triangle, as you see, we've had two types of price action. Impulsive moves lower, no better example than this clearly easy to read 5-wave move down from there to here. Then corrective moves higher. Just look at this, ABC. Then another impulsive move lower, a triangle, another move lower, not that impulsive, a corrective move higher. And this looks to be some kind of an impulse lower. I think there's at least one more move missing to the downside. Bottom line, I don't think that CAD yen is about to turn higher. The very low reading in the RSI, we made it, to hit 19, whatever it is, I think is a testament to that. And as I was saying yesterday, yes, yields do show that they might rebound higher. But one thing is for sure, USD yen, despite being on support, hasn't produced any type of price action that tells me that we're about to rebound. Just look at this. This is a very, very, very weak type of price action, right? I mean, we broke below this consolidation, and just look at this. I mean, we seem to be failing from this support. Of course, it's too early to tell. I mean, we need more time to be certain, but I do think that at the very least we should test this spike low at 104.65. Now, so the combination of how USD yen looks and how CAD yen looks, I don't really expect some kind of a reversal higher. I need to see a lot more evidence to even consider the possibility. Let me go through more of your questions. Please share your view on Aussie and Kiwi. Yeah, sure, absolutely. Let's bring them to the forefront. There they are. So, first of all, very nice reaction from the 161.8% extent. There you go. We had this corrective move higher. I was expecting that it might move, further, but once we broke below this trend line support, it was more than certain that the Aussie was headed to new lows, exactly as it happened. Although we did have a couple of days ago this spike low that was quite a bullish candle as a reversal, especially in combination with the fact that we reached like a major fib extension, and we're now back testing this horizontal support resistance area. You can see the market had found 2 times support in this area as a resistance. So, would I be buying it exactly on resistance? Absolutely not, because 68.30 is an important level for the market. So no, I wouldn't be buying it here. So if you really want to do something, I would say, there you go. Selling it against this resistance makes sense. Now, would I be selling it just because there is this risk-reward ratio and we're on, resistance? No, I wouldn't. I mean, we've had a huge move lower, and we might rebound higher than here. So, in my opinion, it hasn't rebounded enough for me to find it appealing to sell it. But on the other hand, it's been weak enough that I can't exclude the possibility that we're going to get rejected from here. Bottom line, I wouldn't be doing anything with it. And the same applies with for the Kiwi. Kiwi, now this is an interesting divergence because as you see on a daily closed basis, Kiwi never broke to new lows. And usually, and I was talking about that actually a couple of weeks ago, when you see divergences between give me a second, please. Give me a second. Okay. Okay. Sorry about that. So when you see these kind of divergences between very correlated assets, for example, Aussie USD pushing to new lows, clearly pushing to new lows, closing below new lows, while the Kiwi never confirming on a daily closing basis, that also gives an extra point to people that are looking for a reversal. Is it enough? No, it isn't enough, but it is something that I take into consideration. Okay, so Kiwi did hold this support. Can it rebound further from here? Yes, it can. It can. Where would I be looking for resistance in this case? I don't really see any big resistance until almost 66 cents. Okay, so Kiwi looks somewhat better on that chart, but, and I know it's very contradicting, but on the other hand, if you remember, I spoke about that the day that we were reversing. There is a big probability that we posted a false breakdown in the Aussie Kiwi, right? Now, if that gets confirmed, I want to see this 1053 level being taken to the upside, because then we will have cleared the 50, the 200 daily moving average, and we will have also registered the higher high. That would then point to a period of Aussie's overperformance against the Kiwi, in which case, obviously, the Kiwi cannot rebound 66 cents without the Aussie rebounding even further from here. So, you know, taking all that into consideration, as you understand, I'm very skeptical about what I should be doing about the Aussie and the Kiwi. And when that happens, you very well know what to do. Don't do anything with them until you get more clarity, okay? As simple as that. It's not hard to accept that, you know, when you don't have a very, very clear view on the market, the best thing you can do is stay away from it. Now, I want us to have a look again at the bonds. We saw the probability of a pullback, but look at this. I mean, despite 2 days ago seeing a pullback in the bonds, you know, a little bit of a push higher in yields, the bond is just unstoppable. Yesterday we had, you know, quite a bullish day. So far today we just have a spinning top consolidating near the highs. Here's the 10-year, once again, retesting the US Treasury, I mean, right? The 10-year Treasury, once again retesting this ascending channel resistance. So as you see, the bonds aren't really ready to, you know, to give up and roll over. I'm not saying this can't happen, but I'm saying that, you know, the bulls are still putting in, you know, a very good fight. So I think if you want to fade bond strength, we need to see more evidence. If you want to be in a high probability trade, because so far, you know, the trend is your friend and the trend is clearly higher. Okay, and here you can see the 10-year yield as well. I don't really view this price action as, you know, very bullish. We've stalled at the 127% extension of this big rebound higher. But so far the price action looks rather bearish. So who knows? We might have, you know, more downside before we see rebound. Next area of support that I see is the 141.4% extension, exactly at 1.5%. And then the 161.8 at 1.25%. So who knows? You know, we might have a lot more downside for the yields before we see a healthy rebound. And obviously, as you understand, as long as the bonds are ripping higher, there is absolutely no way that the USD yen can really recover. So that means that the yen pairs should remain on the defensive. And having said that, let's have a look at the euro yen and the pound yen in particular, because if you want to be selling them, obviously you want to look for those currencies that are rather weak. There we go. And there you see euro yen. We spoke about that a couple of weeks ago as a shorting opportunity. As you see, it did break below that triangle, and it is approaching the next area of support at 127.2 at 116.50. So far, I just see bearish consolidation here, and even weaker if we have a look at the pound yen, and I'll finish with that so coach can start his interview. Just look at this, because that's even more important. Look at this major trend line support. We've broken below it. We retested it earlier on the week, and we're continuing lower to new lows. Next target I have is the 127% extension of the last rebound, coming at 125.75. So I do think that these two should
Steve?
suffer more in the days ahead.
Okay, everyone, Jim's here now. Those of you that stuck around through this live broadcast interview abortion. So anyway, Jim, it's great to have you now.
Coach.
And I've been telling people that,
Coach,
yeah,
is everything okay? Sorry, I just made it back because I had some bug. Everything okay?
yes, everything's okay now.
Okay. Sorry, but something bugged with my computer, obviously, before I couldn't hear you.
That's okay. Okay, so Jim's here.
Yes.
Thank you, Steve, for trying. It's all Jim Welch's fault. Don't worry about it. Okay,
Yes,
so
it is.
Jim, I was telling people, besides you and me being pretty low tech, that
Can we prove that point?
that you are very unusual, because I remember the Financial Commentator was really based upon following the Fed, and I read your fundamentals, and sometimes I have a hard time wrapping my head around it, but your fundamental research is good, and most people that are very good fundamental guys really aren't great tacticians. They give you ideas, but you have that blend of technical and fundamental. So we're looking forward to what you have to say today, buddy.
All right. Well, thank you very much, Dale. Appreciate it. I am Irish, so as you all witnessed this morning, Murphy was working a little overtime. But, thank you for your patience.
Well, we're good for next time. You could use your laptop.
Now I'm ready to go. All right.
Okay.
As Dale just mentioned, I try to combine fundamental and technical analysis. I have found over many, many years that when the fundamentals start to indicate, a change in, let's say, economic trends, and then looking at technical analysis and seeing things like the advanced decline line and other indicators confirming that, things are starting to weaken internally in the market. And on the fundamental side, it looks like the economy is going to be under pressure. It just adds more conviction to analyzing and anticipating what may or may not be coming. So just very quickly, as we've seen over the last year, as the trade war has escalated, there's been this huge bifurcation. I mean, it's really, really unusual between the manufacturing side of not just the U.S. economy, but the global economy, and the service side. And my view has been, as long as it was contained in the manufacturing side, the services, which comprise a much larger share of GDP in every economy around the world, would kind of hold us steady. But the longer this trade tiff went on, slowly but surely, we would see the weakness in manufacturing begin to spread and infect the service side. And I think the recent escalation last week by President Trump is going to accelerate that process. And from a bigger picture standpoint, back in March of last year, when tariffs were first proposed, the global economy, U.S. economy, was really in a very good shape. There was synchronized growth. Everything was in pretty much gear. So the first round of tariffs merely kind of started to mute the growth. But this additional, as this process has continued, things have slowed more noticeably. And I'll use this analogy. You know, if somebody's walking towards you, to be able to reverse their course, you have to shove pretty hard. But once something starts moving in a new direction, it doesn't take as much energy to accelerate that move. And that's where I think we are in the global economy as well as in the U.S. economy. So we're going to look at really quickly here some charts showing this bifurcation between the manufacturing and service side. And you can see, main thing as I note here on the top is U.S. manufacturing is about 11% of GDP with more than 80% of services. So the U.S. has been so far really insulated from the trade war, or more insulated. Germany's 22%. Their economy has been softening much more aggressively. China's around 30%. So that's one of the reasons why we've been insulated. This bifurcation between manufacturing and services can be seen, like in China, the spread is about 5 points. That is unusually wide, and we'll see in a second. European Union, services. Hopefully you can see this, the little...
Got it.
The light blue line is manufacturing. You can see it's down around 46, whereas the services are hanging out about 53. That's a very unusual gap. Now, looking at it on a global basis, you can see how these two lines typically track each other very closely, both in terms of direction and amplitude.
Yeah.
But this chart is showing the percentage of about 30 different countries whose PMI is below 50. And that's the blue line. And you can see it's up near 70%, whereas the services is near 0%. That's extraordinary.
That doesn't show up anywhere on your chart, this setup prior.
No. That's
unusual, man.
This goes back to 1990. So it's a pretty good history of the last, couple of recessions in the U.S. and so forth. So the point here is, one or two things. Is services going to stay strong, or are we going to see some bleed through? And I believe that's what's going to happen, is that we're going to see services start to slow. And in the U.S., in July, the services went from, I think, 55.7 to 53.7, something like that. In other words, so we're already starting to see the slowdown start to affect services in the U.S. And the ISM manufacturing for the U.S., I think, was 51.2. So we're still above 50. My guess is over the next few months, we will see the ISM for U.S. drop below 50. In terms of consumer spending, when the first estimate of second quarter GDP came out, GDP dropped to 2.1 from 3.1. A lot of that was due to trade, inventory building, but what really saved the day was consumer spending. So when you look at this bar chart of consumer spending, and this goes back to 2009, I believe, it's quarterly. Every time you see these big spikes in the last few years, they're followed by a pullback. This makes sense. Consumers go out and they buy a refrigerator or a car, they buy something big ticket, do a little, maybe they go on a vacation, and then the next quarter they pull back a little bit and pay down their bills. And what we saw in the second quarter is consumer spending was up over 4%, a very, very high number. So even if none of this trade stuff was going on.
Yeah, Jim, even I spent some money last quarter.
Well, congratulations.
All right. Anyway, I just want to let you. That's an unusual event. So go ahead.
So, there's Dale. I can look. If I look at that bar, I can see.
Yeah, I bought a car. I mean, that's consumer spending, right?
That's a big item.
All
okay.
Right. Now I won't have any money for Christmas. Will the rest of America?
Well, it will, but I think there's a natural tendency, for spending to pull back in the third quarter.
Okay.
Irrespective of the trade stuff. I think the trade stuff amps it up a little bit, and we're likely to see a more pronounced slowing. Now, when the employment report was released last Friday, and all this week when I listened to CNBC, people who are and still remain pretty constructive about the U.S. economy, one of the things they reference is, the U.S. jobs report was very good, 164,000. Unemployment rate is still a 50-year low. Wage growth up to 3.2%. And the U6, which is the underutilized part of the labor market, is at a 20-year low. So on the headline basis, everything looks pretty good. I like to try, when possible, to look under the surface. And again, if you were running a business, a small business, and you got 50 employees, and things start to slow down, what happens? What is the natural progression? Well, if you've got a group of employees working overtime, guess what? The overtime goes bye-bye. If you don't, that's a lot of times that's like manufacturing will have overtime. In the service sector, people are working maybe 37 hours a week. All of a sudden, you're going to work 36 hours a week. So these are the kind of forward-looking things as opposed to looking at jobless claims in the unemployment rate, because jobless claims don't move up until people get laid off, and then eventually it shows up in the employment rate. So to me, by looking at some forward-looking indicators that are ahead of that is pretty helpful. So let's look at U.S. job growth and overtime hours. And what we can see, and the dark blue line is the employment rate. So you can see it's held pretty steady, but look at the drop in overtime hours. And if you look back, this goes back again to 1990, we can see that prior to recessions, overtime hours began to drop. Annual market labor changes. This one kind of encapsulates what I'm talking about. At the top, light blue is hourly wages. So you can see it's still up about 3.2%. So the scale on the left is all percentages. Non-farm payrolls, that's up around 1.5%. And it's starting to get down near where it was in late 2017. But as we can see, it's one of the lower readings we've seen. And what this is how many jobs are being created as a percent of the total labor force that's out there. And then finally, total hours worked. And this is where it gets to the point I'm talking about, is wage might be going up from 3.1 to 3.2, hip, hip, hooray. But if you're working fewer hours, what's happening to your paycheck? It's shrinking. And so to me, what these charts imply is that we're likely to see in the next few months, job growth is going to slow. And I think we're going to start to see the same factors that have been at play are going to accelerate a little bit more. So the point is, in the next few months, I think we're going to see progressively economists lower GDP estimates for the remainder of 2019, 2020. We're likely to see earnings estimates start to be ratcheted down. And the stock market's already at a pretty expensive level historically. So the Buffett indicator, which is Warren Buffett thing, is percent of GDP of all stocks. It's at like 145%. It's the second highest in history. So
when was the first? 2000?
I'm sorry?
When was the first? The highest? 2000?
Yeah. 2000. But we're higher than we were in 2007, higher than in 73, 66, and so forth. So the market's expensive. And if you start to get a compression in earnings, I think that's one of the problems that the market faces. Big portfolio managers, mutual fund managers, this all happened a week ago. Think about it. The Fed cut interest rates a week ago, Wednesday, and Trump did his tweet last Thursday. A lot of portfolio managers haven't had the opportunity to really adjust their portfolios. And part of it is some of them are still bullish. They're looking at things like the employment report. If things weaken as I anticipate, they will start to make changes, which means maybe they'll lower their equity exposure by 2 or 3%. In that world, that's a big deal. And it represents tens of billions of dollars.
Jim, before you go to the next chart, can I ask you something? With the Fed doing what it did and that big recovery the day after Powell, I think, people are saying fumbled the ball. That's why the market sold off and we rallied 78.6 back before the Trump tweet on trade. I've heard people say that it won't matter if the Fed cuts because it can't touch the economic repercussions of a trade war escalating. What do you think?
I would agree with that. If you think about it, historically, slowdowns happen for two reasons. Either the Federal Reserve has raised interest rates, so the cost of money, all of a sudden people can't afford to borrow to buy a house and car and so forth. So if the Fed lowers interest rates in that regard, it can really, really help. Conversely, if money's been tight, and money is obviously not tight, and interest rates are obviously not high. So this trade stuff is outside, if you will, the direct connection between monetary policy and the economy. So I would agree with that. But at the same time, equity investors like to believe, that, gosh, if the Fed's cutting rates and other central banks are cutting rates, that's really good for the market. Yes, it is. But at the same time, if the economy really starts to show more signs of slowing, I think that'll kind of, in the short run, be more important. And I think the point you just raised, Dale, is if people start to realize and understand that, yes, the Fed can cut rates, but this trade stuff is kind of outside the impact zone of monetary policy, then they will come around to that point of view. I'm not sure a lot of people have totally embraced that idea.
Okay, buddy. Thank you.
All right, good question. Thank you. All right, so S&P. This is a chart I've been looking at and showing for the last month or so in terms of the S&P. It's basically a megaphone pattern. So off to the left is the 3, which is January of 2018, the high. So what does that relate to, that 3? Well, from March of 2009, I think the S&P is still in a major bull market. Wave 1 up was in early 2011. Wave 2 was the sharp break in the fall of 2011 due to the European debt crisis starting to bubble over. Wave 3 ended in January of 2018. The RSI weekly got to the highest level, I believe, in history. But since then, we've seen a huge triangle, effectively. And so what this indicated to me was that as the S&P got over 3,000, that it was nearing the end of the move up from last December. And what this implies is a decline all the way back down to the lows of last December, and probably taking them out by a small amount over the next few months. So that's the bigger picture. Now you got to take it one step at a time. You can see a couple of areas of important support. The low in June and in March 7th of this year, March 7th of this year, was about 2730. I think the S&P is going to, at least at a minimum, test that level on any kind of a pullback. And then the other major area of support is 2650. So if we look off to the left a little bit, we're just below, after the S&P peaked in wave B, you can see a very sharp break in mid-October, then a bounce, and then another leg down. And I think what we're seeing is we saw the initial decline, bottom early this week. The 618 retracement, I think, is 28
yesterday,
29.49 potentially. So we've recovered most of it, but I think we're setting up for another leg lower sometime, maybe starting early next week. But the bottom line is, I think the fundamental picture is going to deteriorate, and that is going to lead to some additional selling. And the market was oversold, there's rebound. Next week is options expiration, so there's potential that some of the stuff that goes on with options, with the VIX and everything else, could hold the market up. It could actually push a little bit higher. But I think the trend is more likely to be down over the next 1 to 2 months, with the potential that we'll see a drop down to 2350. If this all transpires in the big picture, the next thing to follow will be wave 5 from the March 2009 low. It will take the S&P way above 3,000, 3,500, maybe close to 4,000. So there's a huge move coming after this. What would cause that? Well, I think the Fed not only will cut interest rates, but I think quantitative easing is going to happen at some point in time, whether it's the next 6 months, a year. But we're going to see quantitative easing come into play. Because the Fed just doesn't have the traditional monetary tools to get things going. So basically, initially I went 25% short at about just when the Dow got, or the S&P got to 3,000, increased it to 40% yesterday when the S&P got above 2930, and we'll see. If it goes up a little bit higher in the next few days, I will probably add to that position in anticipation of a leg lower. Okay, the US dollar. You can see, as you guys probably know better than I do, just how choppy the currency market has been since last November. Very difficult to come up with a pattern analysis that really fits into this thing. But you can see, okay, it tagged an upper trend line. Going back, Dale, you talked about Powell fumbling the message. Personally, I'm not in that camp. And I wrote this before that Fed meeting, that there was a group of probably 4, maybe 5 FOMC members the two prominent voting members were Rosengren,
Dissent.
Austin, yes, and George, that, their view was, hey, the economy's still doing pretty good. We didn't need to do this. I think the Fed got themselves boxed in a corner. They had to almost do it. But I thought that those two people would want the Fed to kind of convey a message that the next, September isn't going to be an automatic rate cut. So to me, I thought Powell delivered exactly on what the expectations were. I thought the dollar would spike up to that trend line and then head south. So it's very, very choppy. Could it make another move up there? Yes, it could. But longer term, I believe the dollar index at a minimum will go back to 95 with an outside chance down to 94 over the next 6 months. What will cause it? Counterintuitive. It's going to lower rates. That's supposed to make the dollar go down because, the Fed's lowering rates. That doesn't always work. Conversely, the Fed's supposed to raise rates. That makes the dollar go up. Well, in 2017 and the first part of 2018, the Fed raised rates 4 times. What did the dollar index do? It went from 103.80 to under 89. So this idea that interest rates are the controlling factor of currencies, it's a coin toss. It really doesn't work that often, or as much as certainly people believe. I think one of the main drivers of why the dollar is going to weaken is the U.S. economy has been stronger than just about everybody else, holding up better. Why? Well, because manufacturing is a much smaller percentage than a lot of other places. But if I'm right and the economy shows more signs of slowing, especially if the tariff war escalates some more, I think the dollar is going to weaken due to economic slowing in the U.S. So technically, I think the dollar ultimately, as I said, 95 with a shot at 94 over the next 3 to 6 months. Okay, 10-year Treasury yields. One thing I'll note, if you don't follow the Commitment of Traders report that comes out every Friday afternoon, you're really missing out, I think, on a very important piece of information. Contrary, people say markets are a discounting mechanism. I hear it almost every day on CNBC, all right? And the reality is that's just baloney. If you think about it, and I'm trying to be polite here. If Dale and I were having a conversation on the phone, he knows I would not use the word baloney.
It would still start with B.
Yes, it would. Very good.
Yeah.
Not that there's anything wrong with baloney. Anyway, so the point being is, think about it. When the market was topping in 2007, it made an all-time high in October of 2007. What was the S&P telling us then? That everything was fine with the market? No, we went into a financial crisis. March of 2009, when it looked like the world was coming to an end, what was it telling us? That, it's time to get the money under the mattress? No. So my point is, and I can look at gold in September 2011, 1920. Oh my God, hyperinflation is right around the corner. Didn't happen. So my point is, markets are always wrong at tops and bottoms. Always. Because you get so many people leaning in one direction and they've already positioned themselves. So if the fundamentals start to turn against that positioning, what happens? They begin to be sellers if they're long, or buyers if they're short. And so last fall, if you looked at the Commitment of Traders report, there was the largest short position in the 10-year Treasury bond futures in history. It was like 800,000 contracts. It was unbelievable. That implied, in my opinion, that yields were going to come down. The amazing thing is, as yields have come down, the short position normally, the guys that are large specs and hedge fund, they're trend followers. They're glorified trend followers. Normally, when the market goes against them, they adjust their position. The amazing thing is, since March, the short position went from 160-some thousand to, I think, 380,000 as of about a week ago. So these guys have been getting crushed. So if you're wondering how Treasury yields fell as much as they did from 207 last Wednesday morning to was it yesterday or the day before? So much is happening every day. 160, a lot of it, these guys got carried out. So I'm anxious to see what the numbers show this afternoon in terms of the positioning in the Treasury bonds, because I think sentiment is already really bullish, but I think you really need to see the positioning. And if I'm right about the U.S. equity market making a trip down to 2350, it's hard to see how bond yields are going to go up in that kind of environment. But once that is over, and if I'm right and the Fed starts to cut rates more aggressively, and I think there's the potential for an intra-market or intra-meeting ease. So everyone knows the Fed's going to cut rates in September. And then now in October. I think somewhere along the way, if the market drops to those levels, financial conditions will tighten enough that the Fed will feel compelled to ease. Just like last December and January, financial conditions tightened significantly, and they basically went on stop. So I think there's a good shortcoming in the treasuries. I just don't think we're there yet. My guess is there's a bounce, and then yields are going to come down again and at least test the spike lows that we saw this week. But again, I want to see the positioning. I want to see that the 10-year, the short position, the 10-year has really, really been whittled down.
I may just add that I was talking to Jim before this recent big drop in yields, and he was talking about this, and he said there's just too many shorts left in the 10-year, and that's when the 10-year really accelerated down from 2 to 160.
Yeah. No, I'll be honest. Did I think it was getting to 160? No, I thought it was going to at least get to 170, 174.
Right.
That was the 786 retracement.
Right.
From 132 to 325 is 174.
Yeah. Rubber bands always stretch further than we can imagine.
Yeah. Well, and if you're getting margin calls, you are the rubber band.
Well, I've had a couple.
Yeah. Hey, if you've been in markets long enough and you haven't totally gone through the learning curve. Okay. Gold. Again, positioning. Last fall, when gold was trading under $1,200, the commercials had a long position for the first time in like 20 years. So the position, and large specs and the managed money, they were short. So this positioning is really helpful. It's just another piece of information at turning points. Sentiment on gold last fall was 10% bulls. Now it's 95%.
I remember when that position was grinding you, Jim, and really wish I would have had a video camera on when we went to 1160 in Asia.
Yeah.
That day.
Yeah.
How was that afternoon for you?
That was a sphincter moment.
Good one, bro. All right.
So anyway, my point is positioning is part of contrary opinion. Contrary opinion is one of the most important investment tools that anybody can have. And the reason why it's so important is it's really, really hard. It's always more fun and easier to go with the crowd. And when you get to extremes, basically everyone's negative, everyone's positive, everybody knows all the reasons. Going against the crowd is like the most stupid thing in the world. But it's the best thing. But you have to look at technicals. You have to have some fundamental reasons why you think the story's going to change, and you got to see positioning. So to me, last fall, my point was I felt gold was going to rally to 1480. That was the 50% retracement from 1920 in September of 2011 down to the 1050 level, call it, in late December of 2015. The 618 is up around 1588. I don't think we're going to get there on this move. My guess is there's a pullback coming, and that we'll see that move up to 1588 and potentially higher maybe later this year or early next year. But I think right now in the short run, things are overdone. The commercials have a bigger short position now than they did in January 2018 when gold topped out around 1360. And as I mentioned, sentiment is about 95% bulls. So I think there's another maybe pop left in gold. This long IAU sold half of the position yesterday. And I think if there's another spike above the high we saw a couple of days ago, it's time to sell into that strength. I wouldn't go short here. This has been a freight train. But I do think if you're long, it's time to, and definitely it's not the place to chase. You listen to TV and everybody and their brother is talking about gold, it's been a great place to be, blah, blah, blah. That's right. Been as in past tense. So this is another market where I think we're reaching a sentiment extreme, just like the bonds. But, I don't think the pieces are in place. And again, if I'm right about the fundamental picture that it's going to deteriorate, the equity market's going to have another potentially fairly meaningful leg lower over the next between now and let's say beginning of October. those are going to be somewhat supportive, certainly of bonds and potentially the gold market as well. If we get a drop to 2350, financial conditions will be tightening. There will be margin calls. And, sometimes crazy things like gold gets hit, not because there's anything wrong with gold. It's because I sell what I got to sell to meet a margin call. So I think there's the potential of a little bit of a liquidity event if this scenario plays out. So that's it.
You think about 1380 would be that was a breakout.
Yeah, 1400. Yeah, going back, that's wave 4 of lesser degree, all that happy stuff. So that would be my guess. Yes.
Great presentation, bro.
Hey, thank you so much, Dale. And again, thank you for having me on. Appreciate it very much. And thank to all the listeners.
Yeah, how do people get your letter?
Send me an email, Jim Welsh, WELSH, macro @gmail.com.
You have a slide on that?
I'm sorry?
Do you have a slide with your information?
I didn't do that this time, Dale.
You want to show the website you're using?
Macrotides.com. But the easiest and most direct way is Jim Welsh, macro @gmail.com.
Okay.
Yeah. So
all right, buddy.
I appreciate it.
Yeah. Once we got past the getting connected, Jim, thanks so much.
Right.
We'll get back together, and now we know. Just go with the laptop. You came in. It's not a headset, but the volume was very clear, crisp. That's good. And your message as well.
All right.
Very crisp, and people have some things to think about over the weekend and the coming weeks that you presented. And I tell you what, I encourage people to get Jim's letter so that you're in tune with these kind of things, not once every 3 or 4 months when I bring them on, but that you get it in your email box like I do every time Jim has a view.
If I can say one thing, basically, I do a monthly issue, which really focuses more on the fundamental side of the equation. And then every Monday, a weekly technical review. There's usually a page or two about fundamentals, recent fundamental data points and how it fits into the bigger picture and so forth. And then the rest of the weekly technical review, as the name implies, is reviewing stocks, bonds, the dollar, gold, and occasionally some other markets, but it's all the technical aspect. So, and trade recommendations as well.
Thanks for being here today, Jim. Have a great weekend, my trading warrior brother, for 25 years or so now, Jim. So
I think it's longer than that, Dale.
30. Okay.
About 91, man.
As Blake would probably say, 120 years. He says I've been around forever. So again, some real great charts and ideas that people aren't thinking about, Jim. So have a great weekend, good hunting, and may
the force be with us.
Yeah, and that these trades work out and you clean up. That's always rooting for you, Jim. All right, buddy.
You too, buddy. Bye-bye.
All right, that's it, everyone. That's our week. Hope you had a great week. You're welcome, Khalid. You're very welcome, Samsung and Tom. It will be out on video in a few hours. Baloo will get to it. And have a great weekend, everyone. Enjoy. Remember, don't just count your pips, count your blessings. And the team and I will be back to do our best for you next week as well. Adios.